By learning, you will teach. By teaching, you would learn. Respected BCS President C. Abhay Mehta, Vice President C. Mihir Sheth, Chairman of International Taxation Committee Dr. C. A. Mayur Nayak, conveners of the committee, authors of the compendium, seniors in the profession, and my dear friends. I, C. A. Naman Shrimal, welcome all you to this amalgamation of learning and teaching, the release function of law and practice of transfer pricing in India, a compendium. Transfer pricing bandwagon reached to India in 2001 and had its fair share of litigation. BCS has always been a front runner in spreading knowledge on this subject. Its TP manual, and I think all of us will agree, its TP manual was one of the most revered publication, and our generation has learned its transfer pricing basics from that manual. When the idea of this compendium was shared with me, I would be lying if I say that I was not scared by the sheer vision and the grandeur of this idea. 75 plus chapters, 150 plus authors. It was like a big budget Karan Johar movie in making. But slowly and steadily, the things started falling in place and you could see the book coming up, undated by various spikes of COVID-19. So here we are. To start the proceedings, I would like to invite CA Mihir Sheth, our VP BCS, and Chairman of International Tax Committee, Mayur sir, and both the conveners, Ritwik Bhai and Mahesh, to grace the dais. Our President, C. Abhay Mehta, is online and attending from Zoom. I would now invite BCS President C. Abhay Mehta to give his welcome address.
Thank you, Naman. Chairman of International Taxation Committee, Dr. Mayur Nayak, Vice President Mihir Sheth, invitee from OECD, Ms. Maria or Lucas Mas, invitees from United Nations, Mr. Michael Lennard and Ms. Ilka Ritter, panelists for today's session, Mr. Rajat Bansalji and Mr. T.P. Ostwal, Moderator Akshay Kenkray, CA Mega Vivek Gupta, spouse of late Mr. Vivek Gupta, at whose hands the transfer pricing compendium is to be released as a tribute to late Vivek Gupta, one of the authors to the compendium. Other authors of the compendium present physically as well as virtually, past presidents of BCS, seniors and other participants joining virtually and physically. A very good evening to all. Today I feel blessed that during my tenure as president, the hard work of more than 150 selfless and devoted authors is taking fruition in the form of a compendium on law and practice of transfer pricing in India. BCS is fortunate to be a catalyst in bringing such bright minds together and offering a landmark publication to the professionals practicing in the field of transfer pricing. This publication, though deals with law and practice in India, the principles of evaluation of international transactions remains the same worldwide, thus will be of great utility to the professionals worldwide. With over 135 countries and jurisdictions joining the new two-pillar plan to reform the international taxation rules for ensuring fair share of tax being allocated to the country of operations by the multinational enterprises, the transfer pricing law will play a very prominent role. It is in this backdrop that today's event of release of the compendium is very significant. Another milestone is that we have honor of special address by Ms. Mayra or Lucas Mas from OECD and by Mr. Michael Lennard and Ms. Ilka Ritter from United Nations. I, on behalf of BCS, convey sincere thanks to them for readily accepting the invitation to address from BCS platform. I take this opportunity to especially thank Mr. Pascal for writing a foreword to the compendium. I convey sincere gratitude to OECD for giving permission to BCS to reproduce executive summary of two BEPS reports on intangibles and others, and also the preface of the Transfer Pricing Guidelines 2022. I also convey my thanks to the panelists, Mr. Rajat Bansal and Mr. T.P. Ostwal, for accepting invitation to address participants, and to Akshay Kenkray to moderate the session. For the benefit of the invitees from OECD and UN, as well as non-BCS participants, I would briefly touch upon the activities of BCS. BCS is the oldest voluntary body of CA professionals, which will turn into 74th year in the month of July 2022. Its mission is to disseminate knowledge and to be of assistance to small and medium practitioners. It operates through 10 subcommittees which deal with specific technical areas of practice like accounting and auditing, corporate and allied laws, direct and indirect tax, international tax, internal audit, journal, and also through other non-technical committees. It has around 8,500 members, and I am happy to share that BCS now has more than 11,000 social media followers. This reflects the credibility and popularity of the events and activities at BCS. Its monthly journal, BCAJ, is one of the most sought after by professionals in practice as well as in industry. I urge to all the non-member CAs who are attending this seminar to enroll as members and take the benefit of learning and sharing of knowledge. I conclude by thanking once again all who have been part of this landmark publication. Thank you very much.
Thank you, Obi sir. Next, I would like to invite Dr. C. Mayur Nayak, Chairman of International Tax Committee of BCS, to present his welcome address.
Good evening and welcome to all of you. President of the Bombay Chartered Accountants Society, CA Abhay Mehta, President-elect CA Mihir Sheth, my conveners, Mahesh, Rutvik, Naman, other colleagues, seniors, and my first guru in the profession, CA Prithviraj Shah, under whose able guidance I have done my articles. I'm really happy to receive him. The esteemed Gupta family, all of you, we welcome you. Ms. Mayra from OECD, Mr. Lennard and Ilka Ritter from United Nations, seniors and friends. The subject of transfer pricing is ever evolving, most challenging, and more so in the pandemic times. It is an important and integral part of the international tax practice. The knowledge of this subject is a must for the CFOs of multinational enterprises operating internationally through its associated enterprises. It is important for the professionals advising on cross-border structuring businesses and also the tax administration. The law was introduced in India in the year 2000. We are really fortunate that we have amidst us CATP Ostwal, one of the active members of the International Taxation Committee and a co-contributor to this publication. He was a part of the expert group set up by the government to study and recommend suitable law on transfer pricing in India. BCS had made presentations to the said expert group and thereby contributed in development of the transfer pricing law in India. In more than 2 decades of TP law, many developments have taken place. However, as I said, the law being dynamic, it is still evolving and getting settled. More so in the light of OECD and G20 nations BEPS programs, a lot of developments and changes have occurred in the recent past. United Nations also released a toolkit on transfer pricing. And we are really fortunate that both the organizations' representatives are here today to share with us their respective perspective on the global developments in the arena of transfer pricing. Friends, Naman made a mention about the Herculean task that we had taken up in publishing this compendium. I also fondly remember the 2 transfer pricing manuals, the 2 editions, the last being in 2008, which was at that time a basic document for study of these complex laws. There was a time when India learned transfer pricing from the other countries, and today India is leading in transfer pricing. And training members of many other nations. Friends, I would talk more about the compendium at a later part of this seminar. But suffice to say that we are extremely indebted to all the authors, all the contributors in various other ways. They have contributed to this publication, shared their vast knowledge. We are thankful to CPA Nilesh Patel, ex-IRS officer, who has kindly consented to edit the entire publication. He has gone through each and every chapter and given his feedback to the authors. Authors have taken those feedback in the right spirit, and they have revised their chapters and they have submitted the revised version as well. This way, the compendium has gone through about 2 to 3 readings and thereby enhanced its utility. With these few words of introduction, I once again welcome all of you and wish you all a happy learning. Thank you very much.
Thank you, Mayur Bhai. Let's now listen to the perspective of an organization whose guidance is often quoted in many Indian judgments and all our textbooks, the OECD. But before I invite Ms. Mayra Lucas, Senior Transfer Pricing Advisor at OECD, I would invite Mahesh Nayak, Convener of International Tax Committee, to introduce her.
Good evening, friends. Our first technical speaker for the evening, Ms. Mayra Lucas, is a senior transfer pricing advisor at the OECD. Since she joined in 2008, she has worked in major transfer pricing projects undertaken by the OECD, including the development of risk and recharacterization, intangibles, documentation, and high-risk transactions in the context of the BEPS project. She is currently working on the OECD project on the tax challenges arising on digitalization of the economy and on the review of the CBCR minimum standard. She is also involved in strengthening the cooperation and dialogue on transfer pricing issues with developing countries, with a special focus in the Latin American region. On this note, I'm sure all of us would agree that we could not have asked for a better speaker than Ms. Mayra Lucas to start the technical proceedings for today. Ms. Mayra, the floor is yours.
Thank you so much. Let me start by saying that it obviously is a great pleasure to be here with you today. I'm also very honored that I've been asked by Dr. Nayak to open this event and share with you the work that the OECD does in the area of transfer pricing. Before I do that, I would like to underline how important it is the work that the Bombay Chartered Accountants Society has done in putting in place this remarkable compendium. As you well know, it discusses in great detail practical aspects of the implementation of the arm's length principle. And this work for us is essential because it helps to understand how concepts, which seem straightforward actually in theory, actually work in practice, and the challenges that both tax administrations and practitioners may face when trying to determine the price for related party transactions. So every effort to build a common understanding and to spur dialogue between the different stakeholders is welcome and should be celebrated. Let me move on to our work, the OECD work on transfer pricing matters. As you all know, the OECD is at the forefront of policy making in the tax area. One of the main areas of interest and focus over the past decades has been transfer pricing. We've done a lot, to help understand how the principle that was agreed back in 1979 was reflected in the first guidelines, and previous to that, it was already in the 1963 model convention, how that is actually implemented and should be interpreted. And the work that we have been doing has been reflected in different editions of the OECD transfer pricing guidelines. I want to just make a pause here to underline that we've always had in India a good partner in that work. As some of you might know, India has been working with the OECD on tax matters for some years now. First as a partner, and now more recently as a member of the inclusive framework. And throughout those years, India has been an active contributor to the different discussions on transfer pricing issues, and then more broadly on all the tax issues that we from the OECD we have been working. The most recent ones have been obviously the BEPS project, which was a very ambitious project for which we published the different reports touching on a number of areas, not only transfer pricing, but also information requirements and CFCs back in 2015. Now, as you may know, in the area of transfer pricing, when it related to the BEPS actions 8 to 10, there was some reports that were already concluded and published back in 2015, where we picked up all the guidance on risk and recharacterization. We also developed new guidance on intangibles, intragroup services, but the mandate was broader, and we had certain items that were and pieces of work that were mandated under the actions 8 to 10 that were not concluded back in 2015. We needed some more time. And so we managed to do that work after the 2015 reports. We spent some time revising the existing guidance in Chapter 2 regarding the application of profit split methods. We also developed an annex to provide implementation guidance on the hard to value intangible approach. And probably the most noble piece of work and something that we didn't have already in the TPG was the new chapter on financial transactions. All this has now been consolidated in what is the 2022 edition of the transfer pricing guidelines. And this is really important maybe to make a side note, which is that despite being published in hard copies this year, these three elements, the revised profit split method guidance, the new annex to Chapter 6, and the new chapter on financial transactions actually have been entered into force, if you wish, or had already effectiveness in 2018 for the piece on profit split methods and the annex on Chapter 6, and the new Chapter 10 on financial transactions, what was actually approved 2 years ago in 2020. So that was already there for governments to use. And what we have done now this year in January was to consolidate all those changes and those new elements of guidance and put them together in a new edition of the TPG. I'm not going to go much into the substance of this, but I would like to give you a little bit of a flavor of what's in the 2022 edition. When it comes to the revised guidance on profit split method, we're basically trying to unpack what's already in Chapter 1, and we're trying to provide greater clarification on when would the profit split method be the most appropriate method. There we have described, or we have elaborated on three main indicators. Not all of them are required, but when the profit split method is actually the most appropriate method, they would tend to be present in the transaction that we're trying to analyze. Those three indicators is the existence of unique or valuable contributions on both sides of the transactions. And it doesn't need to be only intangibles. We know that today's economy is driven by intangibles, but the profit split guidance does not require that those unique and valuable contributions take the shape of an intangible. The second indicator is that it's highly integrated in a way that there is a high integration in a way that contributions are given by the parties and in a manner that they cannot be evaluated separately. So we're going, beyond that integration of M&E groups, we're going to look at the actual transaction and whether the two parties are really providing to the transaction something that actually needs for profitability and to materialize the value, the contribution of the other party, and they both need to be evaluated together. And finally, the third indicator would be that there's a shared assumption of economically significant risks, or that if each party is assuming a risk, they are both of those risks that each party is assuming, actually they are really integrated. When you find one of those three indicators, or more than one, actually that would be a good candidate for that transaction, would be a good candidate for the application of the profit split method. Our guidance also clarifies that the fact that there are no comparables is not per se a reason to apply the profit split method. And that's actually an important point, because as you know, there are still many countries where it's very difficult to identify reliable comparables, and resorting to the profit split method might not give you the right answer from an economic or transfer pricing perspective. If we move on to the following piece of guidance, the annex to chapter 6, that annex is trying to actually unpack as well and provide implementation guidance on the provisions that were the hard to value intangible approach, which was already adopted and published as part of the 2017 TPG, and it was also integrated in the 2015 report for best actions 8 to 10. Basically there, what we're trying to do is give some steer to tax administrations. And so this is guidance that's really primarily addressed to tax administrations on under which circumstances you would be able to resort to the application of the hard to value intangibles. As you probably know, the hard to value intangibles is a specific approach that was developed to price transactions involving an intangible for which the valuation is highly uncertain at the time that the parties enter into a transaction. And it tries to resolve the problem of information asymmetry that actually affects both the tax administration and the taxpayer. And so it allows actually to be looking at the transaction several years after it might have happened, and to take into account certain type of information that under a regular transfer pricing analysis, it's likely that you wouldn't be able to use, just because the level of uncertainty and information available for that transaction is different in a regular transfer pricing transaction and one where you would actually be applying the hard to value intangible. And the hard to value intangible, for those of you who are familiar with it, it's something that's, I wouldn't say a new animal, but it picks up from that existing guidance in chapter 6 when we were trying to discuss intangibles for which evaluation is highly uncertain. It goes one step further, as I said, to try to provide a tool to tax administrations to tackle that information asymmetry. I think the last piece there that, it's, as I said, it's follow up from the work that we did on BEPS. It's the new chapter 10, and that's quite new, but the work, if I may say so, it's not new. I mean, some of you might know that the OECD has been trying to tackle and provide guidance on financial transactions for over 20 years. But only now we have succeeded in having a specific chapter on financial transactions. We also had to wait until some of the work under BEPS, for example, on interest deductibility was finalized. Also, the guidance on risk assumption, which is in chapter 1 of the TPG, before we could actually tackle financial transactions. I think here what's very important to say, it's probably that this guidance is trying to, first of all, clarify that Article 9 actually can be used to determine, the right amount of interest, and that you can also, so you can use Article 9, but also we accept that there are other domestic approaches that might be equally relevant to determine when a party is borrowing money, the right arm's length amount of debt. as well as obviously the price for that debt, which would be embedded in the interest rate. We are also trying to provide and address a number, what are the relevant considerations when you're analyzing specific types of financial transactions from a transfer pricing perspective, and which would be the specific elements that you would need to be looking as part of the 5 relevant economic factors that we have in chapter 1. So we're just picking those up and trying to see, okay, which are the relevant items, which are the relevant factors when you're looking at financial transactions. We try to delineate, we try to clarify the difference between delineation and pricing, and to be very clear that you first need to delineate in accordance to what we say in chapter 1, and only when you know actually what's the transaction that you have in front of you, then you can proceed to price that transaction, and not the other way around, or not take as a given the transaction that the taxpayer is presenting. And that's a pretty important point. Another relevant idea that we try to reflect in chapter 10 is the importance of looking at the two parts of the two perspectives of the parties. So we're not trying to analyze the transaction only by looking at one of the parties, but try to also look at the perspectives of the counterparty and what would be the options realistically available to the other party and to your own party to actually delineate what the transaction is. And then obviously you'll see that we have different chapters where we look at treasury, the treasury function and how you would need to price that. We also we focus on cash poolings, insurance and captive insurance. So for those of you who have, maybe clients in that sector or clients, for any M&E, that's guidance that's going to be extremely helpful, or at least we hope so. And that definitely is, something that we're very proud that we managed to bring forward. And probably another point that it's important for you maybe to know is that this 3 pieces of guidance, as well as especially the 3 pieces of guidance, they're not an OECD product only. This guidance was approved by an inclusive framework. And the inclusive framework currently has 141 members, which includes, as I said before, India. So as you can see, is guidance that was approved on a consensus basis, and which reflects actually the position of OECD and non-OECD countries. We're trying to build a system, a transfer pricing system that's as inclusive as possible by bringing as many countries as possible to the table. That's what concerns, the 2022 edition of the TPG. I would like to spend maybe a couple of minutes on the work that we're doing on country-by-country reporting in digital. On country-by-country reporting, this is something that was also a big success from the BEPS project. It's a tool that provides tax administrations with information for high-level risk assessment for transfer pricing purposes, because it requires the M&E group to report information, to report economic information for all the constituent entities of an M&E group. And it allows you to know where that M&E group operates, what is the level of profitability, what is, more or less a rough number on the tax liability in the jurisdiction where it operates. And so it gives a high level picture of the group, its operations, and how much it makes and how much it pays. And so this was approved back in 2015. We've managed to gather, information and on the experience from tax administrations and taxpayers on what works, what doesn't work. And there was a commitment back in 2015 to review the country-by-country reporting, which is actually a minimum standard to which all inclusive framework countries have committed to. So they are committed to apply this to their to M&Es which are above 750 million euros of turnover. And so we have been working over the past 2 years on reviewing that to ensure that we achieve greater consistency in the information that M&Es report, to ensure as well that there is no volatility in terms of the companies that are caught in scope or not. And actually, just to clarify things that, based on the experience gained over the past 5 to 7 years, we know that we need to sort out. And this is ongoing work. We hope to finish it either by the end of this year, early next year, and that will bring significant changes to the CBC report that hopefully helps taxpayers explain their story about their company and their business, and also helps tax administrations to perform high-level risk assessment. As you know, for those of you, if you're attending this conference, is because you are interested in tax and you're interested in international tax. And the OECD has been working over the past, well, this is something that started with BEPS and a little bit earlier, but over the past 4 years, we have intensified our work on developing a two-pillar solution for the tax challenges that arise from the digitalization of the economy. Those of you know that this comes from BEPS, the BEPS action number 1, which already provided a good diagnosis of what are the problems, what is it that we need to change in the international tax architecture. Back then we weren't able to gather sufficient support to change the rules, but after a few years of talking about it and gathering countries around the table, we did manage to get support to put a little bit more of efforts and people to work on it. And since 2018, that's what the OECD has been trying to deliver. The two-pillar solution obviously has pillar 1 and pillar 2. Pillar 1 covers 2 works or 2 elements. One is amount A. Amount A is not going to change the existing transfer pricing rules, but the existing transfer pricing rules remain highly important because the new system is building, amount A is building on the existing international tax architecture to develop a new taxing right for market jurisdictions. So in addition to developing amount A, we're going to be very clear on how that actually interacts with the existing system, including the transfer pricing rules, which remain the same and will continue to operate. The second element of pillar 1 is amount B. And amount B there, it's really a pure transfer pricing animal, if you wish, where we're trying to actually simplify and streamline the pricing of certain types of transactions that we call baseline distribution and marketing transactions, activities. And so, as you probably know, there's significant amount of disputes, cross-border disputes on this type of distribution or control transactions, which focus on the provision of or performance of distribution activities. And when we decided to put this as part of pillar 1, it was because we believe that many of these disputes around this type of activities could be resolved by trying to identify a set of criteria that helps us characterize certain types of distribution activities, and then a methodology that would help us find a price to which all jurisdictions could agree to. If we manage to do that, which is all work under constructions, we are pretty confident that we would be able to alleviate a lot of the constraints and burden that currently face both taxpayers and tax administrations in trying to price those type of marketing and distribution activities. We also think that it would provide greater tax certainty for both taxpayers and tax administration, and it will also hopefully help those jurisdictions that encounter situations where there are no comparables that help them price the control transaction of their taxpayers. Therefore, if we succeed, we hope to improve a little bit the application of the arm's length principle to certain types of transactions that, as I said, would be those involving baseline distribution and marketing activities. This work should be finalized by the end of this year. The aim is that both pillar 1, pillar 2, which is the core of the digital project, will enter into force as of 2023. And we are working, under very high pressure to be able to deliver that to you and to tax administrations. There's a lot more work that will be done, in transfer pricing going forward once we finalize digital. And the reason for that is that, as you know, we face greater integration, we face greater digitalization, and we need that our rules keep adapting to the new economic and business environment. And there, the OECD is ready to help both countries and taxpayers in that process. Thank you very much, and I'm very happy to take questions if there are any.
Friends, if you have any questions, Mayra has agreed to address them.
Thank you, Maira, for such an insightful perspective. We look forward towards more guidance from OECD in coming years. I would request Mayur Bhai to come and say a few words.
Yeah, Mayra, I don't have questions, but I have to thank you for your help. Thanks. Please convey our special thanks to Mr. Pascal for writing forward for this publication. Our special thanks to you and your colleagues for giving us permission for reproduction of executive summaries of BEPS reports, as well as the preface of the 22 transfer pricing guidelines. In the past, we had a special arrangement with OECD, whereby OECD gave us a permission to reproduce or publish an India edition of the transfer pricing guidelines. Also model commentaries 2010, 2017. And a very pleasant incident happened in 2011 when our delegation was at OECD, and OECD presented a transfer pricing seminar to our delegation at your premises. So we have some very good fond memories of our association with OECD. Thank you very much for your today's address to us, where you rightly brought out the various developments which have already happened and which are in pipeline at the OECD in the context of the transfer pricing. Thank you very much.
My pleasure. Thank you.
Thank you so much. Next in the agenda is the most awaited release of the compendium. To take the proceeding further, I would like to again invite our captain of the ship, Mayur sir, to come over here and take the proceeding in charge.
Presentation. Rajat Bansal. Who is also one of the contributor and panelist. A comprehensive publication on the transfer pricing. In December 2020, after the first index was prepared, we requested Nilesh Patel, who has authored a book on GAR, also on transfer pricing, and to join us and help us in the editing the publication. He graciously agreed. And that is where the journey began. In January 2021, We roped in two youngsters, Naman from Jaipur and Karnik Gulati from Delhi, to join us, to help us in coordinating with various authors. And both of them joined with a lot of enthusiasm, and we started the project. The initial deadline was given to the authors was about 30th April. We thought that by that time we will get the first draft of the chapters. On 30th April, the last date of that first deadline, CA Vivek Gupta, he submitted his chapter. Some other authors had also submitted by that time. But then by that time, the second wave of COVID was in full swing. Unfortunately, Vivek contacted COVID, and on 22nd May, he passed away. We offer our tribute to Vivek, though his dedication, his commitment to the cause, and his family is here. We are going to request his wife Megha Gupta to release this compendium. His parents are here, and we welcome you all. After that, because of the second wave of the COVID, many contributors were unable to send their contributions. Rightly so, because their team members, their families were getting affected. The project got delayed. Then we had a 25th ITF conference celebrations. So the committee's focus was on that. And after that, again, when we picked up the momentum, the third wave of COVID hit us. And this time, it was our editor who got contacted. And in the meantime, many of our core members also were affected by COVID. That's why the publication got delayed and delayed. In the meantime, all the chapters which we had received were being reviewed. Comments were sent to the authors. They were revising. They were sending it back. And late 21, we roped in another youngster from Indore, Chaitanya Maheshwari, who contributed on various annexures. And finally, in the month of February, we got the first cut of the book. And we had dedicated 3 days in the month of April, where we assembled at one place and we reviewed page by page, going through the entire manuscript. Again, at some places we had to go back to the authors and get the corrections done. And here we are before you with the final product. So I thank each and every person who have contributed to this publication. Without their efforts, not only the authors themselves, but their family members, their colleagues, their staff, everybody has contributed directly or indirectly to this publication. And I must thank each one of them. And I now request Mayra Gupta to please come and do the honor of releasing it. May I request Mayor Sheth to come, Anil Doshi, Mr. Ostwal, please join us. This is sir. Aye. Gautam bhai, please come. Hitesh bhai. Oh, Akshay, please. Hitesh bhai. Anup, please come. Authors, please join us. Nilesh.
अच्छा नीचे से पकड़ बस साइड में उधर से कैमरा
1 minute. Sir, को दीजिए sir. आप आ जाइए. Come here. I would
Thank you,
request the Gupta family to please come.
Right. Photo चलो, चलो, नहीं, आप रहिए।
आइए. नहीं उनके हाथ में दीजिए.
हाँ।
सबका
बताओ, ये सब है।
फैमिली ना.
हाँ।
आइए प्लीज. आप इधर आ जाइए. उनको तकलीफ है तो नीचे खड़ा.
हाँ वो ऊपर
नहीं,
नीचे
उनको नीचे
उठाएंगे।
खड़ा है.
आप नीचे वापस आप आ जाइए।
खाली इधर घूम जाए. आइए बच्चे आ जाओ. बोल पापा's book.
वापस
चलो बेटा.
ध्यान
बस. Yeah, please.
थैंक यू।
Thank you, sir. Thank you for. Just I will quickly just glance through the slides, which I already talked about. So these are the initial meetings. This is Vivek Gupta. अलग-अलग है. So we used to have a weekly meeting every Thursday evening, online, and then you can see the red lines becoming green, called contributions received, and this is the final contribution. We had two new youngsters joining, Uday Padia and Darshan Nathwani, forward by Mr. Pascal, and this is a special permission for the reproduction of some work. Thank you very much.
Thank you, Mayur Bhai. Lots of pictures you had clicked, and we were not aware about that. Otherwise, we would have given better poses. But that I think, the unseen moments and last 1.5 year journey has come in front of us. I would now request Megha Gupta to come up and speak a few words.
Good evening, everyone. I would really like to thank entire BCA's team for giving us this opportunity to celebrate my husband's meticulous work, something that he wrote just before getting hospitalized. Um, I'm proud to say that I'm standing here today with my family, my parents, my in-laws, my children, and I'm really grateful to my husband for planning everything throughout. We all know that man proposes and God disposes. He is a true soul. Let me tell you, he's the one who actually brought me back to work as CA after having kids. He left one of the big fours to pursue his own dreams. Uh, we all have lost our near and dear ones in this COVID. Let's pray to God to give strength and courage to everyone to move forward gracefully and live with respect. Thank you.
Thank you, Meha ji. Thank you to the whole Gupta family. Next up, we have Mr. Michael Lennard and Ms. Ilka Ritter, who will present the UN perspective on global developments and transfer pricing. And I have a pleasure to introduce them. Mr. Michael Lennard is a Chief International Tax Corporation Section Financing for Sustainable Development Office of the UN. He was previously a tax treaty advisor in OECD tax secretariats and leads the UN Secretariat works on taxation in an increasingly digitized and globalized world and the relationship of tax, trade and investment agreement. He has degrees from the University of Tasmania, the Australian National University and the University of Cambridge, and is currently studying at the University of Oxford. Ilka Ritter is a tax policy advisor for the United Nations Tax Committee in USA, where she is focusing on transfer pricing. She supports the UN Subcommittee on Transfer Pricing in developing guidance on different transfer pricing topics with a special focus on emerging economics. Prior to joining the UN, Ilka worked as a transfer pricing senior manager at EY's Berlin office, where she advised multinational enterprise in the area of transfer pricing and compliance structuring and audit. She holds a degree in business economics and degree in European studies from University of Massachusetts, as well as master degree in public policy. Michael Lennard and Ilka Ritter, we welcome you, and the floor is all yours.
Thank you so much. Unfortunately, Michael could not join our meeting, so I will take over what he was going to talk about. So I wanted to give you a little bit of a historical background on the work of the UN in transfer pricing, and then I wanted to shed some light on what the UN is currently doing on transfer pricing. And I see Mr. Rajat Bansal is also here. So Rajat, in case you want to add anything at any point, just feel free to do so. Mr. Rajat Bansalji is also a participant in the current work of the UN transfer pricing. So the UN started working on transfer pricing in 2009 through a subcommittee. And for those not familiar with the UN is working, or the UN Tax Committee is 25 members who are nominated by their countries and then appointed by the UN Secretary General. And once they have been appointed, they are acting in their own capacity. And Mr. Rajat Bansal was part of the previous membership until 2021, and currently Mr. Das is a member of the UN Tax Committee. So India has a strong history of contributing to the UN tax work. So the members of the UN Tax Committee focus on many different tax topics, among them transfer pricing, and they do so by working through a subcommittee structure. And here the difference to the OECD is that in those subcommittees, also business and advisors work together with people who represent countries and tax administrations. So the subcommittee has always relied on and was able to gain insights from business and from advisors. So the work of the UN in transfer pricing started in 2009, and the feeling was that there was maybe a need for guidance that was more focused on developing countries and their specific needs. And this was achieved by publishing the transfer pricing, UN's transfer pricing manual, with the first being published in 2012 and now the third edition being published in 2021 and currently being translated into French and Spanish. So the first edition has been expanded over time to cover different topics such as services, intangibles, business restructuring, many different topics. And one part that has always been part of the UN work has been that countries are reflecting on their own country practices. And from the very beginning, India has contributed to that chapter and has thereby informed other emerging economies on how they are working on transfer pricing, how their approach to transfer pricing is, and how it may differ to other economies. Overall, we could say that the work between the OECD and the UN on transfer pricing is similar in the respect that it respects the arm's length principle and is in accordance with treaty rules, but there are some differences such as the inclusion of the sixth methods, for example, some subtle differences on location savings and so on. And then, of course, the UN transfer pricing manual tries to be a little more accessible to people who have no long experience of working on transfer pricing and who are just starting in their transfer pricing journey. The manual also includes chapters on how to build up transfer pricing capacity in your tax administration, how to build teams and so on, how to conduct an audit, and that's more detailed and also different to what the OECD is doing. Currently, the new membership of the UN Tax Committee that has started in 2021 has decided to continue the successful work of the UN on transfer pricing by forming a new subcommittee. And we are very happy to say that both Mr. Rajat Bansal and Mr. Rasmi Das are members of the subcommittee. And the subcommittee has decided to focus on 7 topics. And the work is it differs from previous iterations in that the specific topics will be pursued. So there will not be a new UN manual as far as we know, but rather interstitial guidance that will be released over the time of the current membership of the UN Tax Committee. And that guidance includes more detailed guidance on how to resolve and prevent disputes on transfer pricing. There will be guidance on focusing on two sectors that were identified to be important for developing and emerging economies, such as pharmaceutical industry and the agricultural primary products industry. There will be a more practically focused toolbox, toolkit to be used during audits to work on risk assessments and audits. There will be some work on domestic anti-abuse rules. So what can we do domestically to prevent abuse of certain structures and transfer pricing? The subcommittee is also working on transfer pricing guidance on CO2 certificates. And lastly, there will be some guidance on how to deal with times of economic downturn, looking at the COVID-19 crisis, but also other crises, and how that could potentially impact transfer pricing guidance and audits and so on. There's currently, we have a call for comments, which I'll share with the hosts and which they can share with you in case you would like to provide substantive comments on any of the 7 topics I mentioned. And if you have substantive comments, we very much look forward to receiving them. We always like to engage with practitioners such as yourself on these important topics and like to learn from your experience. And yeah, I'm open to any questions, and I'm also looking at Mr. Bansal to see if he has something that he wants to add or something that I forgot to mention. And as I said, I'm happy to take any questions.
Yes, any questions, anybody? Yes, Ritter has agreed to be a part of the panel also. So we will soon be starting our panel discussion. But before that, we have a very pleasant task of felicitating our authors who are present here. And may I request Naman to take over from you.
Thank you, Mayur bhai. I'm just getting that list. So now we're extremely thankful to our respected authors who have contributed to this journey and to this TP compendium. And BCS would like to felicitate them and call them one by one. See, Ajit Jain stays in Abu Dhabi, has come all the way. Hey. Yeah. See Sanjay Kapadia. He's not there. Who is it's there outside. See Gaurav Shah. Gaurav Shah. I would request you to come forward. I request all you to have a round of applause. See, Chaitanya Maheshwari has contributed a lot of annexures. Chaitanya. See, Ajit Jain. TP Ostwal, sir. Not just contributing, but the complete mentoring part of it. See, Nilesh Kapadia ji. See, Amit Kanglani. See, Akshay Kenkray, who is not just the author, but also the moderator for the upcoming panel discussion. See, Rohan R. Vasuna. See, Priyal Vora. We would also request Gautam sir to come and felicitate the speakers. Gautam Nayak sir. Shri Anup Shah. Advocate Shefali Shah. See, Anil Doshi, the chief, one of the chief architect of this TP compendium. See, Abhay Sabu. See, Nilesh Patel, the contributor and the editor. Mahesh Nayak, convener of the International Tax Committee and the coordinator, and one of the contributors. I think Mahesh is there are a couple of more.
The next is Naman Shrimal.
See, Prithviraj Shah. Mayur sir's teacher and the mentor. And yes, the most spirited captain of our team, Mayur Nayak, Dr. C.A. Mayur Nayak. Next one is from Mayur sir's team, C.A. Uday Padia. C.A. Hitesh Gajaria, my mentor. Megha Gupta on behalf for late C.A. Vivek Gupta. C.A. Gautam Nayak. And if we have missed anyone, someone who's contributed, somehow not did not sign, because we have tabulated only from the signatures, and we are missing out on anyone who is there. He left. So once again, thank you all the authors. Mr. Michael Lennard is here, and we'll request him to say a few words.
Thank you very much, and greetings from Oxford. I'm sorry I can only be here. Oh. Hello, everyone. Sorry I couldn't be there for the whole conference, and I'm speaking to you from Oxford. And what I've been asked to talk is a little bit about the UN transfer pricing. I apologise for the light in this room. It's a borrowed room. And I'll talk about some of the history, to the extent it's relevant, of the UN Tax Committee dealing with transfer pricing, and then a little bit about the future in the digital age. And then my colleague Ilka Ritter will talk about some of the work that the UN Tax Committee, through its subcommittee on transfer pricing, is doing at the moment. So first of all, a little bit of history, because I think it's quite relevant. Originally, the UN Tax Committee only dealt with tax treaties, and it was quite an effort to get it to look at transfer pricing, important as though the subject is. The mandate eventually extended to international tax cooperation more generally, beyond just tax treaties, but still most of the people on the tax committee were tax treaty experts and not really open to dealing with the intricate and distinct but related area of transfer pricing. So in about 2008, things started to change. And the reason for that was there was a call from developing countries for more South-South cooperation on international tax. They wanted to learn from countries such as India. And of course, India, we've just seen a cavalcade of tax experts from India, and India is renowned for its expertise in transfer pricing, and also for the enormous number of cases. So when we started with Secretariat, when we suggested that there should be some guidance on transfer pricing to the tax committee, that was supported, including by the then very distinguished member of the tax committee, Anita Kapoor, and we developed the UN transfer pricing manual. And we had, at that stage, we had Sanjay Mishra and involved in the subcommittee, and also TP Ostwal, who's been something of a very, very esteemed fixture in that work and has really made a great contribution, as of all the others. And one of the really interesting things about that first version of the UN transfer pricing manual was that most of the interest, or the greatest interest, initially was on the country practices particularly of India and of China. And I think that was very important to developing countries to see what was happening in India, and also to get a sense for what some of the issues would be for the future. So that was a very important contribution by India to the transfer pricing work. And the Indian DNA runs right through that work. In the manual is really designed to help countries that agree with the arm's length principle, but to sort of speak to them in their own terms, in their own examples of what it meant in practice to apply those principles. It wasn't meant to be intending to be different from the OECD guidance, but to complement that guidance. The second version of the manual, we had feedback from capacity development, and especially that there was a need for more on financing. Again, we had great Indian contributions. Ganapati Bhatt, Pragya Saxena was a member of the tax committee, although not a transfer pricing specialist. She was very supportive of the work. And TP Ostwal, again, was making a great contribution. And that is a significant version, the 2017 version, because it does starts to respond more and more to what we're hearing from capacity development in transfer pricing. The 2021 version is one that I should have said the 2017 version, we started to get the message on financing, but that was actually done in the 2021 version. But there were new chapters on intragroup services, cost contribution arrangements, and treatments of intangibles. 2021 version is one that really took on board this suggestions we were getting that there need to be more in financing multinational enterprises within the tax committee work. And also there's further new content on profit splits, on centralised procurement, and as always, more on comparables. Now there's a new, and in that subcommittee, we had Rajat Bansalji. I see Rajat is there, made a very distinguished contribution, as he always does, and once again, TP Ostwal. The new subcommittee is set to be settled soon. All I can say about that is that Rasmi Dash is on that as a member of the committee, and we're expecting that there'll be strong Indian contributions to that, but the committee has to approve that. So the point I wanted to make is that India has been particularly important to the UN transfer pricing work, learning from the expertise, not just of government people, but also from the private sector. What I next wanted to talk about, Ilka will talk a little bit about the work going forward, but what I want to talk about is the digital issue, the digitalized and globalized world, and what that means for us. And I just wanted to explain the UN position. The UN position is that we are not at odds with anything that is happening in the broader world of digital and the globalized world, taxation of that. But we have to recognize that many UN members are not inclusive framework members. Some are inclusive framework members, but they haven't joined up to the October statement. So what we're doing at the moment, we keep an eye on what's happening in the inclusive framework, but we're also looking at the possibility of having multilateral instrument to make it easier to uplift into domestic treaties Article 12B on automated digital services, which is in the new 2021 just released model tax convention, possibly with 12A, which is fees for technical services, which has been in the model for a while and possibly is subject to tax rule. Still a lot of work to be done there. But that's a recognition that developing countries are looking for solutions in this area that affirm market taxing rights, not as something which they have to be gifted, but something they're entitled to as part of international economic law that already exists and is legitimate at international economic law. They also want simplified, administrable and moderate solutions, bearing in mind the situation of the taxpayers. They want to encourage productive investment. They seek fairness to taxpayers, and they don't want a solution in this area to be limited to new forms of dispute settlement. So I think when you read Article 12B, which Rajat in particular played a big part in drafting, and which was very much developing country driven, those are some of the key messages. And those are messages which carry through whatever happens with 12B, with the UN work on the digital and globalized economy. So all the best for your conference. I'll pass over to my colleague Ilka Ritter to give a little bit more of an update. And thank you for the opportunity to speak from such a distance even. Thank you.
Thank you, Michael. It was amazing to listen the work UN is doing, and and I appreciated the Indian contribution. So we are more thankful towards that. I would now request Ritvik to come over and express a vote of thanks to both Michael and Ilka.
Good evening, friends. Just for Mr. Michael Lennard's reference, Ms. Ilka has already given her address before your talk, and we are very thankful to her. Especially we would be missing our opportunity to appreciate your readiness and willingness to come and contribute to this function, without which this function would have not had the kind of not had that kind of appeal which we today have. All of us were eager to listen to your insights as well as Ms. Ilka's insights, and we are very, very thankful to both of you to join in from and make this a truly global function for the launch of the compendium. We thank you again, and we look forward to more interactions with you and the UN team. Thank you.
Thank you very much. Goodbye and good luck.
Thank you, Ritvik. Now towards the next and the last part of our today's session, the panel discussion. Transfer pricing provision have always been hotbed of controversy and litigation. Add to it hard to value intangibles, increasing service portion in intragroup dealing, global formulary approach, etc., etc. The issues are undoubtedly getting complex to decipher and to apply transfer pricing. To throw some lights on this matter, we have an expert panel chat. I would request the passionate taxpayer Akshay Kenkray, doyen of our profession, CATP Ostwal, an extremely diligent and intelligent Rajat Bansalji who is online, to grace the dais. I would request Chaitanya Maheshwari to come and introduce our panelist.
Thank you, Naman Bhai. On this glorious event, it's an honor and privilege to introduce the stalwarts of our profession, Rajat Bansalji, TP Ostwal sir, and Akshay Kenkray. I am thankful to the BCS for the providing such an opportunity. First of all, the panelist one, I'll like to introduce Rajat Bansalji. He is a senior Indian Revenue Service officer, presently at position of Principal Chief Commissioner of Income Tax, as well as he is a member of the first GAR panel too. As Joint Secretary, Foreign Tax in Department of Revenue, he acted as India's competent authority for a period of 6 years from 2014 to 2019 for treaty negotiations, MAP, APA negotiations, and exchange of information in respect of countries in Asia, Australia, Africa, and Latin America. He had led several important treaty negotiations for India, including important amendment of Mauritius and Singapore DTAAs. He concluded and signed India's first bilateral APA with a Japanese taxpayer in 2014. Further, India-Japan MAP relationship won OECD award for highest resolution in transfer pricing cases for 2019, where he was the Indian competent authority. He was amongst first transfer pricing officers in 2003. He was a member of UN Tax Committee on Cooperation in International Tax Matters in expert personal capacity for the period 2017 to 2021, where he was very actively involved in the work on tax challenges of digitalized economy, UN model updating, UN transfer pricing, handbook revision, and UN dispute resolution handbook. His proposal on digital economy taxation resulted in insertion of Article 12B in UN Model Tax Convention 2021. So we just now heard from the UN team too. They mentioned his name also. So now I would like to introduce TP Ostwal sir. It's privilege to introduce him for the second time, and as his name suggests, he's an expert in the TP transfer pricing. He is a senior partner in TP Ostwal and Associates LLP and DTS and Associates Chartered Accountants. He is based in Mumbai, having almost 4 decades experience in practice, a very rich experience, and scored a CA final rank. He was a member of the subcommittee on transfer pricing for developing countries by United Nations for both edition of UN TP manual. He has been a member of several committees set up by government, Ministry of Finance, CBDT, OECD, and other associations. He is a visiting professor at Vienna University, Austria for teaching international tax to LLM students. He has addressed and presented several papers at national, international conferences on variety of subjects. He has been the first vice president of the executive committee IFA Netherlands and a chairman of IFA India. He is an author of Black Money Act 2015 publication by BCAS, apart from publications on TP of BCA and CTC. He is a regular speaker in most Indian and international conferences on cross-border taxation issues. Now, third panelist, Akshay Kenkray is an Indian tax advisor and a chartered accountant by profession who is well known for his experience in global transfer pricing, structuring, and international taxation, as well as he is founder and leads the transfer pricing focused firm named TransPrice. He has authored multiple books on international taxation, transfer pricing, which is globally well acclaimed. And Akshay Bhai understands the technicalities involved in subject of taxes and global transfer pricing, along with the practical application of complex tax solutions to dynamic industry scenarios. So before we start with the panel discussion, I have an announcement for the authors. All are requested to stay back because after this, we all will have a group photograph. And I would like all the panelists to, all the court is yours. Thank you.
Yeah, thank you, Chaitanya. Yeah. So very honored to be here. I think if you talk about the cricket language, Mr. Ostwal for me is like Sachin Tendulkar. If you saw Mr. Lennard talking about the way and his journey has been, it felt like 1996 World Cup, 2000, 2004, and up till 2011. I hope that journey never ends for you, but really honored to be here. And on the other side is MS Dhoni. So that expectations are very high from me to moderate this panel. In India, transfer pricing has been the talk of town for last 21 years now. It's a full adult as of today. And very proudly, I can say today, India has a very big voice at global forum. As time passes, this subject becomes more and more complex
with new interpretations and situations emerging due to ever-changing business dynamics. The TP law today has become so complex that even OECD in its guidance on Pillar 1 and Pillar 2 overlooks certain transfer pricing principles and focuses on formula-based percentages for attribution. When we do not find answers in certain questions of life, we turn to our gurus to seek guidance. Similarly, when we do not find answers to transfer pricing questions, we turn to our gurus of transfer pricing who today are sitting with us here. With this background, we will go through some of the challenges that we face in India and globally and try to decipher the complex puzzle of transfer pricing. Before I start, let me give you a small disclaimer here. The responses from the panelists today are their personal views and do not represent the views of any government body, agency, or institution. These should not be construed as any professional or legal opinion, but just as a guidance for self-consumption. With this, my first question to Mr. Bansal. Mr. Bansal, am I audible to you?
Yes, yes.
Great. So, Mr. Bansal, you have been a competent authority for tax treaty negotiations, APAs, mutual agreement procedures. So we would love to hear from you certain experiences in this field, which you feel worthy of sharing with the audience.
Thank you,
Over
Akshay.
to you, Mr. Bansal, if you have heard. Yeah.
Thank you, Akshay. Thanks to BCAS and the office bearers, Mr. Mayur Nayak, Mr. TP Ostwal, and everybody else for giving me this opportunity to be here. I must say that BCAS is doing a great service by bringing out these publications. I have been beneficiary of reading the MLI compendium and the GAR compendium, and I look forward to receiving the hard copy of this latest released compendium as well. So my congratulations, and this is really hard work and a wonderful work which will be of great use to everyone. About you have asked me to share some experiences about the treaty negotiations and map negotiations. So firstly, as you said, these are all my personal views and in my personal capacity. And treaty negotiations and map negotiations, APA negotiations, I can speak on for days or maybe a full day. So let me see what would be of interest to the listeners here, and let me try to summarize some aspects of these two different kind of negotiations. So treaty negotiations I'll take up first. What is the importance of treaty negotiations is known to probably all the persons here who are professionals, but nevertheless, I will just highlight this to everyone, that in the globalized world, for cross-border movement of labor and capital, existence of tax treaties is very important. Now, these tax treaties lay down a framework for allocation of taxing rights and other assistances such as exchange of information, mutual agreement procedure, assistance in collection of taxes. So all this is between two different countries and two different jurisdictions, and a framework is laid down through treaties. Now, different countries all over the world have different number of treaties. That depends on their interest and involvement in this work. For example, India has a very wide treaty network, as all of you may be knowing. 94 was the last count I kept track of. It may be slightly one or two more. Now, what is it, how the treaties are negotiated? They're negotiated based on OECD and UN model tax conventions. Very rarely one comes across a different provision from the UN or OECD model conventions really substantially. I mean, there may be minor variations, but having a completely altogether article or altogether different formulation is not very common. And the reason is not very difficult to guess, because you are making the other side agree to it, and you are the provisions are to be globally familiar and acceptable. And the commentaries for these two models are there, and these two models are backed by those commentaries. Interpretation is through those commentaries. Therefore, very rarely one would find difference from these two model conventions. Now, this work is time-taking, and let me tell you that sometimes treaties have taken very long years to be concluded. I saw one treaty when I was in the division, foreign tax division, during 96 to 2000. It was pending for a long time then. And when I came back and I participated in one round, but it was concluded according to me with a minor point remaining. But when I returned to the division in 2014 as the joint secretary, it was still pending. And in 2019, we had another round when it was kind of concluded according to me, but I came to know that it's still pending. So 45 years, it is still pending. There could be other cases where it is pending for long. What are the reasons for that? The reasons are that treaties are negotiated between two countries, two teams, and the teams do change in between. And it's also a political statement of the concerned government and their own outlook towards it. So as they say, nothing is agreed till everything is agreed. This is true for treaties. So till everything is agreed, it is not agreed. What I told you was an exceptionally long treaty negotiation. Generally, it could be concluded in a much shorter time. And after it is concluded, then also sometimes the processes of each country, like ratification or for entry into force, etc., do take some time. But once they are concluded, they have a long life. As you must be seeing that they run for years and rather perpetually, because theoretically there may be a termination clause, but practically they are never terminated. Only very few treaties in the world have been terminated. India has never terminated any of its treaties. What are the main articles on which generally there is a kind of discussion? Well, generally there is kind of difference in initial rounds and which are taken to the final stage, and then only they are concluded. So some of these articles are about Article 5, which is about the permanent establishment. Then there is Article 7, which is about attribution of profits. All income allocation articles are important and they do take time. Generally, the administrative assistance related articles are standard. Some countries may not agree to have assistance in collection of taxes at all. It is there probably only in 50% of the treaties. So there, one may try to convince the other partner, but he may not. That country may not agree. So this is what I will talk about treaty negotiations in substance. Some of our most important treaty negotiations, which I was a party to, as mentioned by someone, was Mauritius and Singapore. It was pending for very long. It got concluded. Two features may be of interest to you, just to recall, or those I'm sure all of you might be knowing. One, what I see as the reason these could be done: firstly, the grandfathering provision, and secondly, the 2-year transition period, which is over, but that definitely made it a gradual process, due to which these treaties could be amended in a shorter time, at that point of time in 2016. Now, coming to APA and MAP negotiations, these are entirely different kind of negotiations. These are case-specific negotiations, as you all know, and the impact of a treaty is much wider than a particular MAP or APA case. But these are very important from the point of view of bringing in tax certainty, dispute resolution, and above all, elimination of double taxation, because otherwise one country's dispute resolution mechanism done unilaterally may not result into full relieving of double taxation, which is achieved through the MAP and APA mechanisms. Then APA is more complex than MAP. MAP is generally a single year. Maybe it has 3-4 years. And it may have a precedent value, but generally an APA is a 9-year process for India, including the rollback, and it involves projections for the future, so that makes it more complex as compared to a MAP negotiation. Then there has been a great deal of progress in APA and MAP negotiations in last several years, as you all might be knowing. I would just like to share with you a few aspects why that has happened. Firstly, the focus on the MAP increased globally due to the BEPS Action 14, where conclusion of a MAP was assigned weightage rather than endeavoring to resolve. prior to that, it was still the language is the same, but BEPS Action 14 provided an average time limit during which the map cases are expected to be resolved. And it was a monitoring of the map inventory of the world, due to which the map cases came into focus. And it was very good because ultimately resolution of disputes through map has been a very useful work in the area of international movement of capital all over the world, because it reduces the concerns of the multinational enterprises, non-residents and foreign companies which are participating in other countries' economy. Now, just to give you a flavor, the MAP partners and APA partners of India have been increasing over time. And from long back, when only US, UK were the partners, or maybe Japan had started in 2000, in the 1990s later part, Mr. Ostwal will know, because probably he was the first map case proponent for India. He represented the first map case for India, if I recall correctly. Therefore, up from there, we have traveled a long way. And now we have a long list of countries in Europe and in other parts of the world which are participating in MAP and APA both. And cases of varied kinds are there: manufacturing cases, services cases, then industry-wise, the software industry, ITES, so software development, then automobile manufacturing, and there was a case of a tire manufacturer, then Japanese big conglomerates called Soga Soshas, heavy machinery, etc. There is a variety of MAP and APA cases that India is seeing now. So sometimes, just last point I'll like to share with you is the challenge in APA negotiations due to the different regulations of the two countries. That kind of challenge is there in MAP negotiations also, but it is more prominent in APA negotiations, where sometimes the rollback provisions of the two countries may be different, or where the time periods of the two countries may not be exactly aligned. Then what is to be done to make it work is sometimes interesting, and that is also taken care of in these negotiations. So Akshay, I'll stop here, because as I said, this is a topic on which I can go on and on, but looking at the constraint of time, I will stop here.
Thank you, sir. That was a great insight. Maybe just a follow-on question to you, if you may have the answer to this. Many a times I have seen maps which are led by other countries onto India. Have you come across a case where map is basically initiated from the Indian side against other countries?
Yes, interesting question, and something we have observed ourselves in the ministry. Yes, there are instances where MAP was initiated by us. At least I was a party to initiation of MAP in not as many cases, or rather not even comparable number of cases as we have inflow of, but there was instance where MAP was initiated. Reason is obviously that one reason obviously till now has been the inflow of capital into India and the non-residents and foreign companies working in India, and their cases getting audited here. Maybe once India is outreaching and we are having subsidiaries and presence outside, there could be MAP cases initiated by us as well. But still, even now, I find the number of MAP cases initiated by Indian taxpayers to be less as compared to probably there should be.
Thank you, sir. Thank you, sir. Mr. Oswal, you have any add-on to that, or shall I go on to the next question?
No. One of the reasons why maps are not initiated by Indians against the foreign companies or foreign countries is very simple. That whenever you are required to pay the tax, you are compelled to pay the tax in the foreign countries. That taxes paid abroad is given credit to in India so far, because we had no foreign tax credit rules. But now India has gone into the foreign tax credit rules. Therefore, the disputes in the future possibly would arise, and the Indian authorities may say, now this credit has not been, the charge of tax has not been done correctly. You take a refund in that country and don't take a credit here. In that case, possibly you will have to initiate MAP against the other countries. Great. We have experience, as Mr. Rajat Bansal had helped us in initiating a MAP against China, and he resolved. He was a competent authority. He resolved the map.
Great insights. So my next question is to you, Mr. Ostwal. I'm going a little bit more transactional here. 2012, I think there was an amendment. Now this is relating to the delayed receivables, when specifically receivable was included in the definition of international transactions. So while it is considered as a part of international transaction, the other side of receivables is sales, which ideally any taxpayer generally they benchmark it and it's proved at arm's length price. For me, over the years, benchmarking receivables have been one of the toughest challenge. What to see, whether to go to the aging summary, whether to look at the year-end receivables, what is the time frame we should look at, whether there should be any credits given against the early payments that are made. So floor is open to you, sir. I would love to have that guidance from you.
Well, when you are talking of receivables, when you actually speaking, when you do a transaction of sale itself, that is supposed to be benchmarked at that time. If suppose a particular method we have used,
right,
so that credit period is already inbuilt, price is charged accordingly, and therefore there is no further receivables or transfer pricing required to be done.
Correct.
But if there is a delayed payment of receivables, then whatever original method which you have followed, same method should be followed for the receivables not received in time. For example, if you have followed cup method, we have two decisions on that subject of cup method. And if you have followed cup method, there could be possibly an internal cup. You look at the internal cup available. If you are giving credit to the third party and given credit to your related party, what is the difference? And if you have charged interest, what is the interest you have charged and what interest you should charge it to your related party? So therefore, there would be possibly there is a decision directly available on this Indo-American jewelry and Livingstones is a cup method. If you're following TNNM method, there is some methodology difference which would arise, and therefore you can also do a transfer pricing on receivables. And I think we have a direct decision on Kusum Healthcare, Delhi High Court, on two different methods. The third, fourth method, of course, generally there would be similar type of exercise one has to do it. We do not have much precedence on the other methods, but these two methods are already directly available.
So are we expected to go through each and every transaction of receivable?
Now, the question is whether it is transaction by transaction or whether it is aggregate.
Or whether it is year-end.
At the end of the year, you look at the total credit granted, total number of days you have delayed payment has been received, and at the end of the year you do it.
So assuming at end of the year, I'm a smart businessman, 25th of March, I asked my debtors to pay up. My receivables somewhere goes down. So from a end of year perspective, my receivables were never high, but on the transaction by transaction, my receivables throughout have been more than my...
No, tax department does not do that. They look at the total whole year transactions and then look at the total outstanding and period for which you have delayed receivables. And then accordingly, they will say that, okay, we'll calculate. Unfortunately, the controversy is sometimes you receive the payment also in advance, and sometimes it is delayed. Normally the fair and proper method is you should give credit for the early payments received as well.
Right.
And then accordingly net amount, like calculation of interest product which we calculate, do in similar fashion practically, and that is most defendable. Courts would go by the method followed by the taxpayer. The tax department may do anything, that is their problem. Our problem is to resolve their problem.
Right. So the guidance coming from you is transaction by transaction.
Yes.
Give credit to the early payments which has been made.
Yes.
So that's a long list of work that any professional may have to do to just benchmark receivables or to prove to the tax authorities. Look at the...
No, you are taking up a case where every transaction related parties have delayed the payment. Why do you take such a case? There would be few cases where delays are taking place. If it is a chronic delayed payments, then you should revise your terms of doing transaction with the related party. So, and then therefore, if the credit extended to them is of a longer period, then receivable will be also received in time. So therefore, there would be no separate benchmarking. The original transaction itself will be required to be benchmarked.
True. So maybe just for an argument's sake, FEMA as a separate law
Ah.
provides 9 months for you to get your receivables. Why there is one more law, or why there is FEMA, which dictates that you should get receivables within certain amount of days?
Objective of both laws are different. There the receivables are to be received, foreign exchange has to be collected in time. And whereas income tax is concerned with the transfer pricing is concerned with the adjustment to be made, because if the receivable you are giving longer period credit than the you are giving to the third parties, only related parties you are giving longer period credit, not receiving money in time, your pricing has to be a little higher. Ultimately when you are nobody can get a free sandwich.
Sure.
Something has to be paid for. So you are selling some goods keeping in mind the number of days he is going to take for making payment to you in turn, and therefore you will calculate your price keeping in mind the interest receivable for in loss of interest in that period. Your cost will be inbuilt accordingly. So you'll have to do a calculation.
Right. Thank you for those insights.
And therefore both laws are nothing to do with each other. Both are separate. Now, definition of non-resident under income tax and under FEMA is different.
Correct.
Why that is different?
Sure.
It's different. It's different. That's all.
Mr. Bansal, any thoughts on this? Would you like to take it up, or?
No, I think Mr. Ostwal has summarized it very well, and you have also supplemented it. I don't want to add anything more.
Great, thank you. So, Mr. Bansal, next question to you is mainly on corporate guarantees. Now, if you see this particular transaction and see the judgments around it, they are on both the sides. Some judgments say they are shareholder transaction. Some judgments say that corporate guarantees are basically an international transactions. And even after the amendment of 2012, this tussle continues. So how should one taxpayer address this entirely?
I think after the amendment, yes, there was a decision that where there was a doubt that it is an international transaction or not. I think by Delhi Tribunal, but later by Bombay Tribunal, it was clearly held that it was an international transaction. And keeping the tribunal decisions aside, if you look at the amendment in law in section 92B, then it's quite clear that a guarantee is a international transaction, and it was done retrospectively through that amendment. So, and what the Delhi Tribunal dwelt on was that it has a bearing on profit and loss, and it does not have a bearing on profit and loss. I think it was, if you read the explanation, then it is not linked to the main section, and it's very clear that guarantee is on a standalone basis an international transaction from henceforth with retrospective effect. So therefore, and even practically, I find that most of the professionals, as far as my experience goes, I have not found them contesting that corporate guarantee is not an international transaction. Maybe the issue is more about the quantum of arm's length price of the corporate guarantee, not of the not whether it is an international transaction or not. So I think that debate has been kind of set to rest, and APAs also, I saw that corporate guarantee transactions are covered transactions for APA purposes, and the issue was about the quantum only. So I would say that this work is can be said to be one area where the disputes are not so many, and probably it has got settled to a great deal of extent.
Well, dispute is inherent part of a practice. Taxpayers dispute, and the tax department is bound to create disputes. So therefore, we are here to see the situation is not going to be resolved so quickly. New disputes will come up. But on this corporate guarantees and all those subjects, UN last third version of UN manual has given guidelines on the subject, and still we are in the fourth version or next version, possibly it requires further deliberation. There are a number of issues on performance guarantees and this and that, whether commission should be charged or not. These are issues which are not so simple. It is a perplexed issue. It's not that easy to resolve the problem. But only problem, what Mr. Bansal said is right. It is the question of determination of arm's length price for this type of guarantees which you give. And major disputes are arising because the tax department used to charge 3%, 4%, 5% guarantee commission. 9 and 10% you are saying. Whereas the banks, comparable transaction, bank, when you charge the guarantee commission based on AAA rated companies or based on rating of the companies, they would charge 0.25% guarantee commission. So if that be the case, how do you expect the department to make an adjustment like that? That is why the courts were aggressively against the income tax department.
Nowadays, no, sir, there is a different litigation going on. Bank guarantee and corporate guarantee are different.
No, I agree. I'm not comparing corporate guarantee. In fact, corporate guarantee, there is no expenditure at all. You are giving pure a guarantee based on your own net worth.
Yes.
So therefore, where is the reason for charging such a high corporate guarantee fees? Minimum, ultimately, it is my subsidiary. And there are, again, cases you had earlier some discussion, the shareholders function and the non-shareholders function. If a guarantee is given as a shareholder and it was presupposed, instead of funding my money into subsidiary company, I give guarantee and the foreign subsidiary takes the loan at a much, much lower rate of interest there. Holding company is benefited out of that. Absolutely. In fact, holding company should charge some fees, very nominal fees for that. Sorry, holding company should pay something to the subsidiary company because they have not blocked their funds. This is a new theory.
No, true. That's what the shareholder activity says.
Yes.
But just to supplement what Mr. Ostwal said, if you allow me to come in for a half a minute, the UNTP manual has made has provided very good guidance on corporate guarantees. When Mr. Ostwal said that, I'm reminded of that. And one clarification there is about the implicit support. So implicit support is, as per UNTP manual, it is not to be reckoned for as a corporate guarantee. And even the safe harbor rules, if you look at that, they also talk about explicit corporate guarantee and exclude the implicit support. So just wanted to add that.
Thank you, sir.
Thank you, sir. So talking about disputes, Mr. Bansal, next question is to you. In your view, is the dispute resolution panel an effective mechanism to solve transfer pricing disputes? And as a wish list, what more could be done to bring in certainty to the transfer pricing regime?
Dispute resolution panels are actually having a very noble objective to Mr. Ostwal is smiling, but probably I did not intend it to be a joke. I was serious about it. And legislatively or framework wise, everything is there. And actually, I found out that yes, recently there has been quite a few cases where, if not full, then part what the directions are there, partly they are found to be good by taxpayers. I keep talking to people, so this was the feedback I got on some of the aspects. If you look at it at the framework, you see it has got everything. 3 senior officers of the department are there, and they have all the powers to get into the matter. They have time of 9 months with them to issue directions. Decision is by majority, so it cannot get stuck. I mean, it's not a case of consensus-based decision. And therefore, and mostly I would say for transfer pricing in particular, dispute the DRPs should be very good forum to resolve the matter, because these are fact-oriented cases most of the times, and fact-finding, whatever the assessing officer has done and referred to the DRP can be seen by the DRP and addressed fully. If I mean, within fully may not be acceptable from their point of view, if not from the point of view of the applicant or the assessee. So yes, on the other side, I keep hearing about the dissatisfaction with the dispute resolution panel, sometimes from some of the tax practitioners. So, but whenever the taxpayer has a issue, the appeal is possible against the order which passed as per the directions of the dispute resolution panel, and it straight away goes to ITAT. So in a way, time is saved, and the matter is straight away before the ITAT. So in nutshell, I would say that this is a very useful mechanism, and maybe some implementation issues are there, due to which probably it can get even better. But utility wise, I find it to be a good forum where a lot of issues can be resolved and settled at the DRP level.
Thank you, sir. You have any follow-up comments?
No. When Bansal Sahab said I'm smiling, I was smiling only for one reason, that conceptually dispute resolution panel, which was introduced by India, is a unique concept in the world. No other country has the similar concept, and therefore India has taken a lead in resolving the dispute through this unique method. So therefore what he said is a noble, conceptually yes, but in reality it is not working well because the human beings involved, and we had the laws. You have seen changes happening. Earlier the dispute resolution was final and it was not appealable. Officers were not agreeing, they were saying no, the other decisions are in favor of the tribunal, then the dispute resolution has followed that. The officer will not in a position to appeal, so therefore they will disallow that. So these disputes of dispute resolution panel were subject matter of different type of decisions by the lower authorities because of the appealability or non-appealability. And ultimately the composition, despite the fact I have my experience shows the composition is of 3 members, but only 1 member listen to you, the other 2 members don't listen at all. They just even they don't even note down, like in the tribunal all the judges write down their comment and observations, but in the dispute resolution panel the 2 members just sit down and 1 member listen and he only passes an order. So therefore noble concept, not implemented seriously.
So great. Mr. Bansal, you have anything to add to that?
See, as Mr. Ostwal also agreed, it's a noble concept. I said that it is having everything to go for it, and implementation could be there may be things that could be better. At the same time, I would say that for transfer pricing matters, the MAP and API are also there, safe harbor is also there. So therefore, quite a bit of options or alternate dispute resolution mechanisms are there. And the later ones, which I mentioned, have the benefit of relieving double taxation through in the other country, because they are accepted by the other country while they are being when they are being done. So, but at the same time, dispute resolution panel has its own importance, considering the very large number of cases in the country, and maybe everyone is not very keen to. I do not know the reason, but maybe not everyone is taking the MAP route or the APA route. There could be reasons for that.
Sure. Thank you, Mr. Bansal. I think this will be the last question in interest of time. We have already run out. But TP sir, last question to you. As per you, what is in stores for transfer pricing in global business decision making? And do you think after pillar 1, pillar 2, the way how guidance is, would a global formulary approach be the next concept in line to simplify a business life rather than TP?
Very nice question. You see, the approach to the transfer pricing, your question was, first part of the question is, what is store for the transfer pricing in a global business decision? Today, if you look at all the board meetings, quarterly board meetings, related party transactions comes for the discussion, the most important item of the agenda in audit committee, and how the benchmarking is done. maybe local, maybe international, all the transactions. They come into the before the board meeting. So the transfer pricing has become such an important subject in the board agenda in all the companies, which are major companies we are talking of, not small companies. And therefore, this is very, in a global business decision making, it is routine now. It is very, very routine and very, you can't ignore that. When the matters are being debated at the board level, now you can imagine what is the importance of in a company. So therefore, all the companies are now talking about creating global transfer pricing policies, etc., and they follow accordingly and give guidance to the public at large. Unfortunately, the 1995 guidelines of US OECD, followed again by UN, has the same 5 methods of transfer pricing methodology. That is, and now 6th method, which Ilka talked about, is that only on a commodity, on the mining companies, etc., in some of the countries of Africa and also South America, which is propagating, and we have followed. It is the extension of cup in a different method. But frankly speaking, arm's length price, my personal opinion, all along is purely a theory. There is nothing practical about it. In real life, if you say the pricing can be determined based on this arm's length theory of 5 different methods, the world would have gone somewhere, you know. Ultimately, you do it at the end of the year and talk about the contemporaneous documentation and all those things. If the businessman knew what price Mayur Nayak is charging to his client, I would compete and compete with a lower price and take away his client. That is not possible. And therefore, transfer pricing is a purely theory. And this theory is imposed by OECD on the world. And now they are realizing that theory is going against them. Earlier, they created the FAR as analysis method, function, assets, and risk. The developing countries were poor chap. They were not in a position to negotiate and compete with the developed countries. So we accepted that. India has been raising a voice that marketplace should be given importance. You are a manufacturer, developed country, and you are ultimately selling to my country. Today, my liability has become my asset. The population, which hitherto was liability in the country, has now become asset. Every country want to procure this marketplace of a country like India or China, because they want to sell more and more product here. And if they want to sell more and more product, if they sell more and more product, they make profit. And they say profit is because we manufacture, not because we have sold. How can clapping be done by one hand? The clapping has to be by 2 hands. You have manufactured and you have sold. Unless you have sold, you can't make a profit. And therefore, marketplace should be given importance, which we have been asking. I have written this article 2008 or 9. FAR is farce. FAR versus farm. FAR analysis and farm analysis. FAR, function, asset, and risk in marketplace, must be compared. And if you do not give importance to marketplace, how can, and this was not acceptable to the developed countries. OECD was objecting to this. Ultimately, when the global turned down, and thanks to our Indian members who also participated in inclusive framework and the BEPS development, and they brought OECD to understand if you do not give this importance, it is not going to be acceptable. So now they have found out what to do. The digital taxation was a major problem, because this problem got aggravated. Without being physically present in the country, you are in a position to sell your product and then say, I have no permanent establishment and therefore nothing is taxable. And they have been very successfully doing it. Google has been doing it. But later on, of course, we are also innovative. We said it is royalty, it is fees for technical services. So these are all problems. Now, because of without presence, the goods are being sold in the other country and they are making profit, and that profit was not getting taxed. And voice was raised by India more so by anybody, because our voice is heard. We are the only country. I thank Mr. Rajat Bansal, having contributed greatly in the UN tax committee and similarly Mr. Das greatly contributed in OECD's BEPS in inclusive framework and made them to realize that this should be given importance. Mr. Rajat Bansal is known for contributor of Article 12B, which is known. The world over it is known now. It will be known as Bansal's article. And therefore, what was the reason? He has propagated, of course, I would take a view that his suggestion is a better approach than Pillar 1 and 2 approach. Pillar 1 and 2 talks about most complicated life in the tax history of how to allocate the profit, how to calculate the profit, and that was why did we contrary to the OECD work, he gave a simplest solution: create a TDS, withholding tax, like fees for technical services, separate, and there is a formula. Everything he has given. The article is beautiful. One has to read Article 12B. So therefore, when we are talking about attributing profit based on marketplace, the US was not agreeing. The other countries were not agreeing. The digital economy framework gave 3 options: equalization levy, significant economic presence, and the TDS. The world realized that this is going to create problem. Of course, OECD was smart. They gave option to the countries: you create your whatever rule you want to follow. And people followed equalization levy, people followed significant economic presence, people followed TDS, and we followed all the 3. And that brought America on table. They came quickly. Finally, after the Trump went away, new Biden did not realize what mistake he is making, but he agreed to bring on the table the taxation problems and resolve. But he said, no, digital taxation problem, we are not agreeable. We will give you a better solution. What he said, only 100 top tax groups of the America, mostly Americans, you decide their global profit. And we will find out where they have done a business. And we will attribute the profit to respective jurisdiction appropriately. And that is again great all theory. Again, most complicated. Suppose you are you go to Singapore, you buy some computer in Singapore. Profit of that sale of computer, Hathaway or HP computer, will be attributed to Singapore or to India, because customer is in India. They say, no, we will have mechanism to find it out. You done a transaction on a cash basis. How can they find it out? If you have done transaction on a credit card basis, they will be able to find it out. So these are problems. But nevertheless, some solution has been worked out. And the transfer, ultimately, the OECD now realizes global formulary method is appropriate method. No, he's not totally saying. He is one of the appropriate method whereby we will find out the profit and allocate the profit amongst the countries where the goods are being sold. And therefore, it is gradually and slowly is entering into the era of transfer pricing again. After 95, arm's length price, global formulary portion method. In other words, our Rule 10D is going to come back in 10A of the income tax rules of India. This is what I believe. There will be further development, and tax professionals have nothing to worry about it.
So I think that brings us, Mr. Bansal, any words on this particular aspect?
No, thank you very much.
Okay, so we come to this end of the program. Naman, you want to take?
Thank you, Bansal sir.
Thank you very much.
Thank you so much, Akshay. Thank you so much, Ostwal sir. Thank you, Bansal sir. Before I request Jagat to do a formal vote of thanks, we have our printer here also, for Appu from Finis Printer, who will bring whatever contribution all the authors have done to actually into the book format. So thank you, Appu. Let's have a round of applause for the Finis team. Again, to remind all the authors, we will have a photograph session just after this end of this session. So please be stay here. Now I request Jagat Mehta to come over and give a well-deserved vote of thanks to the panelist. Jagat.
Friends, before I give a vote of thanks, may I request Mayur Bhai to give a memento to Akshay Bhai and to Ostwal sir? Yeah. Yeah, and may I now request Mihir Bhai to give another memento to Oswal sir and Akshay sir? And Bansal sir, we will be sending these mementos to you. So right now, please accept in on online virtually. Akshay. Before I take the pleasant task of giving vote of thanks, there's a one announcement which we would like to make. Friends, BCS is coming out, has scheduled a 26 ITF conference from 4th to 7th August, and it is at Hotel Ananta. We have a Superbird early price, Superbird early discount, which is available till 25th of May. So in case any one of you have not registered, please register at the earliest. Now coming back to the pleasant task of giving vote of thanks. Friends, the sirs, Dil Mange More. आधा घंटा बहुत छोटा लगा. Yeah. So when we have Sachin and Dhoni on the field, we are all hooked to our seats and always say Dil Mange More. And here we have top of it, we have Alimdar, who moderated this session very well. So it is indeed a privileged task to give a vote of thanks to such a stalwarts. So I'd like to thank Akshay for moderating this session and raising practical issues. And would also like to thank Oswal ji for giving us insights which were practical and definitely enriching for all of us. I would like to thank Rajat sir for giving us what is happening on the international tax arena, as well as even on the different aspects that Oswal ji and Akshay ji stated. So with this, friends, may I request everyone to give a hearty thank you.
Thank you, everyone. Authors are requested to join us outside for a group photograph. Thank you, everyone. Have a wonderful evening.